Select 50 Fund Focus. I'm joined today by Richard Woolnough, the manager of the M&G Optimal Income Fund. Richard, thanks very much for coming in today.
Thank you.
So just describe what the fund is, what its aims are and who it might appeal to.
The Optimal Income Fund is a very wide-ranging fund. There are three basic asset classes you look at as a corporate bond investor or a corporate bond fund manager such as myself. There's the higher quality government bonds, tend to be very high quality, very unlike its default. There's a mid-range of bonds, which are investment grade bonds, the likes of a British Telecom or a Marks and Spencer's or a Walmart that sits in the middle. And then there's high yield bonds. And high yield bonds tend to be something like House of Fraser, something that's challenged in terms of either its business model or highly leveraged and has got a higher probability of default. Traditionally, most of the bond funds you can select in are categorized in one of these areas. When we launched the Optimal Income Fund 10 years ago, we wanted to get away from that constraint. So this fund can invest in the asset class it prefers most, whether it be investment grade, government bonds or high yield. And occasionally, when the income stream that we can buy is cheapest through the equity, we're allowed to loan a small amount of equity in the portfolio as well.
Okay, and obviously as the name suggests, it is all about generating an income.
Yes, it is about generating income, but it's not about generating an income here and now.
Yep.
It's not about trying to have a dividend or the highest yielding bond fund available.
Yep.
It's thinking, am I getting paid enough? Is that income stream attractive from a risk reward characteristic? And if we are getting paid very well, we'll increase the size of risk we have in the portfolio because we're getting paid for taking risk. If we're not getting paid very well from a credit risk perspective or an interest rate perspective, we'll pare that risk down. So it will change over the cycle.
Yeah.
As the asset classes change over the cycle and they change in value, we change the mandate and the positioning of our portfolio.
Okay, so it's moving around all the time. At the moment, what does the balance look like? Are you more towards the sort of safer governments or the high yield, or even have you got some equities in there?
We're focusing more towards the investment grade area with about neutral in high yield, but investment grade. We think the world economy is working. We think monetary and fiscal policy has worked. It just works with a lag. You should see that UK unemployment continues to go down, US unemployment continues to go down, the European economy is recovering. So we think the monetary and fiscal policy taken over the last 4 to 5 years is working slowly, but it's working through the system. Therefore, we want to have credit risk. At the moment, the market doesn't believe it's working. The Bank of England are worried that it's not going to work, judging by their latest policy measures. So we think there's lots of value there in terms of where the market thinks credit faces a recession or a slowdown. We think a recession or a slowdown is unlikely in the immediate future. Therefore, we want to own the risk of owning credit.
Okay, now we've got 2 or 3 of these flexible strategic bond funds on the Select 50. How does yours differ from other types of these kinds of flexible funds?
Well, I can only speak about my fund. I think one of the things that makes us a little bit different from other bond funds is that if we think the best income stream is in equity, we will buy equities in the portfolio. The most we've ever been is around about 12.5% of the portfolio in 2012, 2013. Finding equities that provide a long-term income stream that looks good value versus where their bonds are or where their debt would trade. That was very low for the last couple of years. It's been towards zero. And only since the rally we've had in interest rates and the rally we've had in corporate bonds meant post-Brexit, lots of equities around the world started to look value against us on our traditional measures. So we have about 4% of our portfolio in equities. We constantly monitor that. The best income stream we think is from equities. We'll add that to the fund. Otherwise, we'll avoid them.
Richard, thanks very much indeed.
Thank you very much.